Sending a file is easy. Making sure your clients understand the file is the hard part. But with PDF Spaces in Adobe Acrobat, you can give your clients the full picture with custom intros, audio summaries, and a helpful AI assistant to your docs. So if you want to stop the endless follow-ups, do that with Acrobat. Need to make your docs crystal clear? Do that with Acrobat. Want to make sure your clients get everything they need to hear? Do that with Acrobat. Learn more at adobe.com/do that with Acrobat.
So there's a lot of noise about AI, but time's too tight for more promises. So let's talk about results. At IBM, we work with our employees to integrate technology right into the systems they need. Now, a global workforce of 300,000 can use AI to field their HR questions, resolving 94% of common questions. Not noise, proof of how we can help companies get smarter by putting AI where it actually pays off, deep in the work that moves the business. Let's create smarter business. IBM.
When you're running a business, the best days are the ones where priorities stay on track. For midsize and large companies, risk can affect multiple parts of the organization at once, from property and liability to cyber and regulatory challenges. At that level, managing risk becomes an ongoing discipline. At The Hartford, the focus is on helping businesses manage risk before it turns into something more disruptive. And when losses do happen, that work is paired with insurance coverage shaped by years of underwriting, risk engineering, and claims experience. Learn more at thehartford.com/risk mitigation. Policies provided by Hartford Fire Insurance Company and its property and casualty affiliates, Hartford, Connecticut.
Welcome to Inside Active, a podcast about active managers that goes beyond soundbites and headlines and looks deeper into their processes, challenges, and philosophies in security selection. I'm David Cohne. I lead mutual fund and active research at Bloomberg Intelligence. Manager selection has become significantly more complex over the past decade. Investors today have access to more strategies, more data, and more managers than ever before. But with that abundance comes a different challenge, distinguishing between performance driven by skill, process, and durability versus outcomes shaped by market environments, factor exposure, or simply good timing. Today, I wanted to explore what separates truly durable investment managers from those that may only look compelling for a moment in time, and how experienced allocators approach that challenge. Joining me to discuss that is Paul Cavazos, Senior Vice President and Chief Investment Officer of American Beacon Advisors. Paul, thank you for joining me.
Hey, great to be here, David. Thanks for having me.
So let's start at the beginning. When you begin researching a new manager, what are the, first three things you look at before even considering performance?
Yeah, well, hey, maybe just quickly before getting into kind of a response there, it may be helpful to frame how American Beacon approaches manager selection as a firm.
Sure.
We were built around an open architecture model with really like a long-term partnership mindset. So what our CEO Greg Stum would say was, we don't date, we get married. And so from the beginning, we focus on, finding differentiated external managers that are very active, doing the work to understand whether their edge is real and durable, like a consistent performer, and then building, lasting relationships around, the strongest opportunities for investors. So that kind of philosophy, of rigorous selection, thoughtful product structuring, and really a long-term view are the backdrop for how we think about, evaluating managers today. But yeah, and look, so as you said, like performance is important, but the first things we really look at are philosophy, process, and people, behind it. And we want to make sure, the team has the experience, resources, discipline necessary to execute on their process consistently. We also look at things like capacity, portfolio construction, whether it's a good fit, and role to play for the broader product structure in our platform. Certainly performance matters, but we think it really comes down to the first things we look at are philosophy, process, and the team.
How much of manager selection is quantitative versus qualitative today? And you think it's kind of shifted at all over the last decade?
So look, I think there's great managers, in both camps. I do think with AI lately, David, right? You're seeing more data and more kind of quant information quantitatives taken into really like the front end of aspects of investing, and some call it kind of, I kind of don't like this term, but quantamental. So you have quantitative combined with fundamental. I think how we look at it, maybe peeling that back a little bit, is we really see, quantitative and qualitative outputs as complementary rather than competing. So we do think, quantitative work, when we're looking at assessing kind of a manager and underwriting them, we certainly look at quantitative factors like performance, risk, attribution, consistency, whether, results line up with the manager's stated approach. And from a qualitative side, it's just as important because, numbers, can't tell you how decisions are actually being made. So how does the team function? Does the process hold up into certain environments? Why or why not? So we do think, there's a combination of both quantitative and qualitative to really factor in when looking at a manager holistically.
So, you had touched upon a little bit, focusing on the process over the outcome first. That's what you're looking at. In practice, how do you distinguish between, a repeatable process and someone who just might have had a great cycle?
Sure. I think it really does come down to whether, there's that consistency there in the outcome that you can trace back to kind of clear disciplined process. Does it follow their philosophy? Or was it really helped by just some, macro environment backdrop, right? That happened to be favorable. So we do really try to look for evidence that the manager can explain what drove results, how those decisions connect to their stated philosophy and process. And, I would say though that we are also looking at kind of factor analysis, right? So we use FactSet to kind of look at it. So before we even go in and talk to them, we're kind of seeing, hey, what were those factors like? How is their portfolio constructed, and what kind of benefit that had? So we go in there with kind of, that lens to begin with, so then we can have more pointed questions and kind of really see how they respond to that.
So is that how you can kind of tell, whether the performance came from skill or just being positioned correctly?
We think that is really helpful. Yeah. So we do try to separate it. Sometimes it's hard depending on the environment. Um, but a strong market, a style tailwind, broad factor exposure can make a lot of managers look good for a period of time. So we do spend, a lot of time on that attribution. Again, construction, consistency of the decision making. Of course, we want to see that those excess returns are in fact coming from kind of bottom up stock selection. If that's what they claim to be their edge, right? If that's supposed to be 3/4 of their performance over rolling market cycles, then we certainly want to make sure we're seeing that, because as you know, then if stock selection is bad, um, that's gonna hurt them then in those cases where they're not making good picks, or the market moves against them. But yes, that repeatability and that consistency, is really something that we key in with every one of our partner sub advisors.
So I guess how long of a time frame? Because one of the things I think of is, some managers might have an edge, but, could it be arbitrage away, when other folks are kind of following that, how do you kind of evaluate that?
Yeah. So we do tend to look at, kind of rolling 3 and 5 year periods, but we think, the durability of a manager is really rooted in something structural or hard to replicate. So what are they doing differently than others that can help them be, consistent over time? It could be a differentiated research process. It could be, hey, they're just really deep in expertise in the areas that they play in. They might have a strong network that helps them get some insight. The team culture is also something we look at, and do they have scale and flexibility? So if if the edge does depend on something that can be easily, copied or screened for, we want to understand that and take that seriously. But if it comes down to like their overall judgment, experience, and a process that's been refined over time, that tends to be more durable. It doesn't mean that it's, week in or week out or month in or month out that they're going to outperform, but that's what we try to review. And look, we're reviewing these things on a quarterly basis with all of our underlying managers. So yes, we do a lot of due diligence on the front end to onboard, a sub-advisor partner, but it really comes down to that ongoing relationship and that ongoing re-underwriting of the managers that we think differentiates what we do and helps us have a better understanding in our view of how that manager should react in certain market environments or not.
So when you're meeting with managers, what are the types of questions you ask them, or you think that, they tend to reveal most about how they really think?
Yeah, look, the best questions are usually the ones that force a manager to move beyond, their polished narrative and explain how they actually make decisions. And we've all been part of those meetings where you get some kind of slick, very smart and also very talented at presenting. And you're kind of like, wow, that's fantastic. But you really have to look, beneath that veneer. I think one of the best things is like, hey, talk to us about your highest conviction ideas. What mistakes have you made? What are they debating like internally right now? And what would cause them to change their mind in a position? So you learn a lot when you walk through a decision from beginning to end and what they saw, what they weighted, what risks were considered. You know, did they ever think about doing something and they didn't? Why not? And I think that's where you get a lot of good information from that. I also think being able to talk to different team members, not just kind of the polished, client PM or the real good marketer, and sometimes even the lead PMs are very good at. Sometimes they're really smart, but not the best at giving the message. But some are very good, and then you have the polished marketing person. We like to talk to the lieutenant, the junior PM, the analyst, and what we really like to do, David, is if we can, let's get some of those, more junior folks like an analyst or senior analyst alone and talk to them. So to us, that can be extremely beneficial because you might be surprised what they share, or sometimes when you're like the executive on the thing and you say, well, here's how we do it. And then you talk to the people that are kind of really doing the analysis and a lot of the quantitative stuff on the front end and everything. You can learn some interesting things.
So if we talk about what you're looking for, do you think there's any part of the process that's overrated? Is it just kind of people focusing on performance alone, or?
Yeah, look, I would say I'll go back to one of the things I just mentioned. Like, I think some people, it's overrated if you're just doing due diligence and you're just talking to those polished people in the polished presentation. So, and I also think the other aspect of that is short-term performance. I think, look, we're all human. And I do think like retail folks in general, I know this, David, but like they'll tend to chase performance, right? And that's probably not what you want to do. I think both of those things can be useful, but neither tells us enough on their own. And so, kind of a great presentation can make a process sound more differentiated than it really is, or a recent short-term track record might not reflect, kind of the true skill. So in our experience, it's better to look kind of under that surface. Again, rolling 3 and 5 year periods, in and through and out of market cycles is what we want to see. And we also want to see obviously risk adjusted performance, not just top line performance. Like how much risk are they taking to get that? And yeah, I think that's really, and to us, those 3 to 5 year periods are really what folks should be looking at. And you could say, hey, a market cycle now, Paul, has been a lot longer, with kind of financial and monetary policies and everything like that. But in general, if you get beyond 3 and 5, people are going to say, well, why would I look at 10? So that's why we tend to focus in on 3 and 5. And we do think that can give you, again, rolling cycles of 3 and 5 we think can be very meaningful.
What about red flags? I mean, you mentioned risk. Are there other kind of red flags that would kind of immediately move a manager that's, probably not the best fit for you?
Yeah, I think there's a number of them. I think for us, the biggest ones come back to inconsistency, lack of transparency or communication, or a process that just doesn't match up with the outcomes that we would think you would get from that market. So we had, as an example, a value manager. Now we do kind of like different flavors of value within our multi-managed value products. And so we have kind of a deep, a core, and a relative. And that relative value manager, David, was becoming a lot more growth leaning. And this was at a time when it was beneficial from a performance standpoint.
Yep.
And so I think when you see that, there's a lot of questions we had, and we did move on from that manager, even though they did lights out, but they weren't sticking to the discipline in the space that we needed them to be in. And so it was the right decision for us because when we offer something to a client, to an investor, we want it to stay true, right? So I guess if they can't clearly explain how decisions are made, if the team appears unstable, if risk controls are secondary, and if the story, you know, continues to change on how they're doing things, that's, obviously that's a problem. Those are going to be red flags.
So I actually have a follow-up to that, just talking about actually value. You kind of brought up a good point. And, there were a lot of, I think, value managers that were picking up, I guess, discounted tech stocks after, the bear market. And then, if they're holding it too long, once they become growth stocks, is that kind of something you'd be looking at?
We would. And, look, how these indices are created, and you guys have some good ones, but maybe some other firms don't have. It's kind of like how it's divided up. You have really big, large mega cap kind of growth names that are in the large cap value index. So it does become hard. So look, if our deep value guys are looking at that in that same kind of multi-managed portfolio structure that I alluded to earlier, that could be a problem. If it's the relative value manager and then they are trimming it once it does get, that maybe makes some sense. Um, but certainly like in the large cap space, right? It's been tough to be an active manager with the whole AI, and the Mag 7 and all that going on. And I suspect that's still going to be somewhat of a talking point, right? Here going forward. But yeah, you do see that.
So that kind of brings up to another question of, we kind of talk about when you're meeting managers and kind of doing your due diligence. What does the ongoing due diligence look like at American Beacon, while you're kind of continuing to monitor them?
Yeah, and so as I mentioned a little bit earlier, that we do think this is a differentiator for us and for our firm. We don't believe a lot of other folks are kind of re-underwriting, their sub-advisor partners on a quarterly basis. So we do that quarter in and quarter out, and it does take a lot of time. Again, doesn't mean we're going to be perfect in finding, pivots or issues, but I think it provides definitely a better lens. So we're just not peripherally looking at, oh, this was their performance, for the period. We're really looking at, again, that people process, is there any changes in the philosophy? Is the culture still, intact from what we can see? And again, that helps in talking to different levels of folks on the team. Are there organizational changes outside of the investment team that we should be concerned about? What about from an operational perspective? So we try to be as fully encompassing as we can. And again, we think that, is very helpful. And then like even capacity. So we look at capacity all the time, particularly in those areas that you would expect that are more capacity constrained. But we're constantly talking to them about even those aspects to say, hey, if we can sell a $500 million more in a small cap, are we okay? Like, is that good? Is this amount that you gave us before still accurate, or can we get more at that same price point? So all of those things are coming up, and we do think it's been helpful for us to identify some problems in the past.
So, what would actually cause you to lose conviction in a manager when
Yeah.
you're doing this?
So yeah, we I think when something changes and we can no longer kind of explain the strategy with the same clarity we once could. So that might be a shift in people, a drift in process, unexpected risk taking, inconsistency between what is said and what is done, or results that no longer line up with the stated philosophy. Like, hey, you're a relative value manager, and all of a sudden they're kind of like a heavy growth manager. So, from a style perspective, um, underperformance by itself, I guess I'd say, is not usually enough because good managers will go through difficult periods. But the bigger issue is when the reasons we believed in the manager to begin, with start to erode and we no longer feel, the process is as coherent or repeatable or trustworthy as it needs to be is when we lose conviction.
So, I mean, my focus is active. And, I think, the general thing is when people think of active is they tend to do, or they tend to really show their merit during down periods. And so, what do you think separates managers who do well or survive difficult periods? What separates them from the ones that kind of unravel when the market turns against them?
Yeah. So I do think the managers that navigate, tough periods best are usually the ones with a process they really understand and believe in, right? That combine with the discipline, importantly, to stay thoughtful under pressure. So they tend to know, kind of like what they know, why they know it, and what kinds of environments should or should not favor them. They're not improvising, in difficult markets. They really stay true to what is it we do and have to believe the fact that, hey, when quality, as you know, David, as a factor last year was one of the worst periods to have quality as a key discipline in the last, what, decade and a half or so. We have some managers that absolutely have outperformed like last year and are continuing to struggle a bit, but they're staying true to what they do, and that's actually very meaningful. If we saw them veer off that course, we would have concerns. And by the way, now if quality comes back and they're not participating, we're going to have some other, challenging discussions. But somebody that really knows who they are and stays true to it, that's what we think separates, the good managers.
Okay. I also want to ask you about concentration because we all know, what's happening with, the large and mega cap companies, making up such a huge part of some of the large indexes. If we talk about concentration risk, are you being more cautious about highly concentrated managers, or do you kind of view it more as evidence of conviction?
Yeah, look, I think the latter. Yeah, so we do have, we have a lot of different um, products on our platform, right? That vary greatly. But those that have high conviction, I mean, we like that. So we are an active shop, right? And so the title of what you want to talk about is just right up our power alley. We strongly believe in it. And so we do have a lot of managers that are very concentrated and have great conviction around that. And there's certainly risk aspects to that you have to make sure you're disciplined from that perspective as well. But we think that can that can be a great philosophy and strategy to have. Certainly in definitely some specific asset classes, right? And so we value that. We try to find managers that have high conviction. And some would say, hey, conviction is if you have, in a large cap, 40 to 60 names, or even maybe a little bit more than that. And then we have some that are, in small cap or high yield or in large cap growth that are, 25 to 35 names. So it's all in how we gain comfort in each of those managers in those spaces that they play in, and results speak for themselves. And sometimes in a multi-managed um, type of product set that we have one of those managers that is very opportunistic, very concentrated. Look, they can ebb and flow. They're a lot more volatile than the other managers, but in that context of a multi-managed product, it works extremely well.
Okay. And there's another topic I want to ask you about. It's also kind of top of mind in the fund world is private markets. And so I was just curious how much of your manager research today kind of extends into private markets versus, typical public strategies.
Yeah. Yeah, so we do have a fair amount, for sure in private markets that we do from a diligence standpoint. We we are also so our team, my team acts as an outsourced CIO as well, and so we've been doing private markets since the late '80s, and thankfully very successfully. So we have that backdrop that maybe not a lot of people not a lot of people know about. And so, yeah, as there's more, kind of the democratization of private markets, we are looking at that and how we can be helpful and really call on our expertise of multi-manager, differentiated, active, kind of types of portfolios that we can construct and really call on that to, we believe offer products that are going to be useful in specifically like the wealth and retail channels. So yes, we're doing a lot in that space, and you might see more to come here in the not so distant future.
So when you're doing that, though, does your evaluation process change between the two?
Yeah, no, thanks. Look, I think there's some aspects of it that are different, right? Just from the different structures and from liquidity management and all that. So that is absolutely, you have to dive into that more and make sure you have the right structure and the right product for the right type of client. And we've seen some of those issues kind of happening here where you want to have full transparency there. But from the standpoint of evaluating, again, kind of people, process, philosophy, and all that, a lot of that can be the same, right? Um, but again, you do spend typically a little bit more time on sourcing, what's their underwriting discipline, how is the portfolio constructed, what is the governance structure, um, how the firm behaves across longer, time horizons, right? And less frequent pricing points. You have to understand that and appreciate that. And then from an operational standpoint, just to bring that side in, even though I'm the CIO, I'm not the operations guy, but you better have good operations folks that understand how everything ties together, the right trustee, custodian, and really, can you value these things properly and accurately? And how are you, communicating that in a relevant and transparent manner?
Okay. I just have one more question before we go. With your experience, with manager research and oversight, what lesson do you believe most allocators learn too late?
Yeah, that's a great question. I mean, I think what many allocators might learn too late is that manager selection is not just about picking a good manager, it's picking the right manager for the job, right? So, um, a strong track record might be attractive, but if you misunderstand the role that they play or the risk profile or how that strategy behaves in difficult markets, it can still maybe not be a great decision, right? So that's where I think those multi-managed value funds that I've been kind of mentioning a couple times here, I think that makes a lot of sense. So those in essence, again, we have relative, we have deep, we have and then kind of core traditional, and then in small cap we have kind of an opportunistic manager that can go wherever the deals are, and that's that highly concentrated manager. So I think you have to understand what role are you looking specifically for that manager, to play, and that's of paramount importance.
Okay. Well, thank you. Unfortunately, we need to end here, but this was a lot of fun, Paul. I really appreciate you joining me today.
Now, well, thanks a lot. Thanks a lot, David.
I also want to thank our listeners. If you liked the episode, please share it, subscribe, and leave a review. And if you'd like to see more of our research on the terminal, go to BI Fund Go for fund and active research. Until our next episode, this is David Cohne with Inside Active.
If you follow markets, you know the value of long-term thinking. You plan, you diversify, you prepare for volatility. But in life, even the best strategies can't prevent every bad day. A fire, a loss, a disruption that demands immediate attention. When that happens, what matters isn't just what you planned, it's who shows up. That's where Cincinnati Insurance comes in. For more than 75 years, they've helped individuals and businesses navigate life's toughest moments with care, expertise, and personal attention. Together with independent agents, Cincinnati Insurance focuses on relationships, not transactions. Their approach is grounded in experience, follow-through, and trust built over time. Bad days happen, and when they do, you deserve an insurance partner who understands risk, respects what you've built, and is ready to help you move forward. The Cincinnati Insurance Companies. Let them make your bad day better. Find an independent agent at CINFIN.com.
From coast to coast, unlock adventure at Red Lion Hotels by Sonesta, where restful sleep, friendly service, and trusted local knowledge are part of every stay. Red Lion makes it easy to feel welcomed, comfortable, and connected wherever the road takes you. Whether you're traveling for business or pleasure, you can spend less and make more of every trip. When you sign up for Sonesta Travel Pass, you'll get their best rates instantly. Go to Sonesta.com to book your stay and unlock the best rates with Sonesta Travel Pass. Here today, roam tomorrow. Join now at Sonesta.com. Terms and conditions apply.
This dog salon? Operational excellence. Thanks to Genius from Global Payments. Scheduling? Personalized. Checkouts? Instant. Absolutely genius. Big league reliability for any business. That's Genius.